is Grace Bennett from the Family Building Society.
Hi.
Wait for this to load. And if you've received your post and you've seen the stuff in the post from us, you would have had one of these, but you would all have had one of these in email, by email this morning. This is an 8-page document. We've just literally revamped this earlier on this week because there were some changes to their products. So we decided to include all their products. Even Grace hasn't seen this now yet, so I need to send her a copy probably.
No.
It's more like a Bible
than
a product guide, to be honest with you. I could hear a tree falling down the distance when we were printing this. So just have a look at that. Page long, tells you everything you need to know of what the current products are and everything else. So a little bit first of all about Grace. She's been working in financial services for 3 years. Hobbies include socializing, traveling to new places, and binge watching the latest thriller series on Netflix, which, as you can imagine, takes up quite a bit of her free time, me and you both. She loves meeting new people, which is why she enjoys the job so much. Interesting fact is that Grace has completed a skydive over the Palm Jumeirah, I think I pronounced that right, in Dubai, most experience of her life. And as I said, I did embarrass her last time that Grace did one of our presentations, but Grace has been an absolute superstar during lockdown. I mean, many lenders have been good. Grace has been exceptionally good. Just one of those people you phone with like your inquiry, and she's literally been so on the ball. It's like we're her only broker. Which has been unfortunately for more, but it has been like we're our only broker, so she's been absolutely fabulous. So take advantage of that, people, by the way, because it's they are a very, very good lender to actually have on board. So Grace, what happens now, this is completely different from the last time because your slides, I've actually added these introduction slides to your presentation, so over to you.
Okay, perfect, thank you. So hi everyone, yeah, I'm Grace Bennett, Business Development Manager at the Family Building Society. I cover the home county, so if you're within the home counties, I'm your BDM, but we have 6 regional BDMs all across the country. So if you're not in the home counties, then let me know and I can put you in contact with your BDM. That's the best contact number that you can call me on. Any inquiries that you have, just pick up the phone. I'll be more than happy to help you with anything there. So I'll just go through a bit of background about Family Building Society, and then our USPs and areas of lending that we can help you and your clients with. And then, as you know, any questions that you have at the end, don't hesitate to ask. I'll be able to answer them for you. So a bit of background about Family Building Society. We're a trading name for National Counties. If you haven't used Family before, you may know us as National Counties Building Society. We rebranded at the end of 2016 to Family Building Society. And the reason for the rebrand was it was a name that suited sort of our areas of lending and where we were trying to achieve in this market. So that being first-time buyers, we can consider mortgages for an applicant age 18 plus, and then to applicants right into their 90s. So as I said before, we started off with 1 national account manager and then branched out to 6 regional BDMs. So being the Family Building Society and having a name that supports our areas of lending, we do a lot of intergenerational lending and a lot of mortgages for different applicants at different stages in their life. So that being lending into retirement, interest-only mortgages. We offer buy-to-let mortgages, mortgages for expats, and then our family-assisted mortgages as well. That being our joint borrower sole proprietor and our 95% family mortgage, which I know sort of in the current market that we're in, it's quite hard to find. So I'll go through that in a lot more detail later on in my slides. So us as a lender and where we stand with our underwriting, we are a manual underwriter. Every single one of our cases is assessed upon its own merit and case by case. We don't have that computer says no policy. So if you think it's sort of a bit unusual, something you're certainly not going to find with a high street, pick up the phone to us and run through the inquiry. We can always refer anything to our underwriters while they're not working in the office at the moment. They're easily contactable. Just pick up the phone to them, run through a case. As long as we've got the okay from an underwriter, that will then support your application throughout. We don't credit score, we just credit search. And yes, like you said, there's just that common sense approach to everything that we do. We offer some incentives to our mortgages as well, so that being free valuations up to 500,000. And then after a discounted valuation fee thereafter. And that is on our residential mortgages, and we've just introduced that onto our buy-to-let remortgages as well. We also offer free in-house legal services as well on our residential remortgages. If an applicant did want to instruct their own solicitor, then we'd contribute £400 towards their legal fees as well. So I'll start off with lending into retirement, as this is our biggest area of lending. This is where we do most of our mortgages. The most common scenario for us is an applicant that's with the high street on an interest-only mortgage, say in their mid to late 60s, and looking to remortgage away from their current lender because they're looking for their money back. We then come into place as we act as a real alternative to equity release mortgages. We can lend to age 95 on a repayment basis. So great flexibility there with lending into retirement. And you may be wondering, well, how can the applicant show that they can support that mortgage into retirement? So we offer acceptable income streams, sort of all different in lending into retirement. So you've got your state and private pension. Even if the applicant is still working, we can work with projection of that income. We can also look at large pension pots. These do not have to be drawn down from. We can take 80% at the moment of pension pots, and what we'll do is we'll simply divide it by the required term. And most commonly, so what we're finding at the moment is actually limited company directors who have a family-run business, and their son and daughter, say, have then stepped in and taken over the management of that company, allowing their parents to take a step back and enjoy retirement. As long as it can be confirmed by an accountant that that is the case and that's how the business is now run, then we can take that income right to age 95, say. And then other sorts of income that we can take into retirement can also be rental and investment income that's declared on an SA 302. So interest-only mortgages. So although we do lend into retirement on our interest or repayment basis at age 95, we can actually offer a huge flexibility for our interest-only mortgages as well. So someone aged 70, we can do a 16-year term for them. And then sort of at the age 86, we can potentially then look at another 5-6 year term for them as well. So they're not limited for our interest-only mortgages and the terms that we can offer our clients. So there really is no barrier to entry with our interest-only mortgages. So we can accept up to 75% loan to value where there's a suitable repayment strategy in place. If one of those repayment strategies are going to be downsizing, which is most common for us, then we can do up to 70% loan to value, but we don't ask for any minimum equity or minimum income or minimum property value. As long as we can see that the applicants can comfortably downsize within a 5-mile radius, then we can accept that as a suitable repayment strategy. All the underwriters will do is they'll look at Zoopla or Rightmove and look at the possibility of them to comfortably downsize. In terms of affordability, we can actually do a pure interest-only calculation where the term is 10 years or less. Any term longer than that, that's when it is stressed on repayment. Specialist Finance do have access to our interest-only fixed-rate products, that being a 2-year and a 5-year fixed rate. Being a 5-year, we can actually stress it on pay rate as well, which, you know, would be a bit more generous to affordability. So lending to self-employed applicants, I know at the current sort of situation we're in, they are being referred to our underwriters. I know sort of for me as a BDM, we're asking for 2 years accounts for our self-employed applicants. I'd refer it on to them and get the approval from the underwriter to confirm exactly what income they're happy to take from that applicant. But we see someone as self-employed is someone that has more than 33% share in their business. And where we become niche, we can actually use a proportion of their net profit and potentially look at the most recent year for that as well. We don't rely on salary and dividends. We can take salary and net profit as well. So mortgages for expats. This has been very, very common at the moment. I was really surprised actually. The majority of my inquiries are expat lending. So we can offer expat mortgages for on a residential and a buy-to-let basis. Exact same loan to value apply. So on a residential basis, it's maximum 75%. On a buy-to-let basis, we can go up to 65%. We can accept up to 45 different countries in total, and as you can see there, those being Australia, South Africa, Hong Kong, America, and then alongside the Europe and the Middle East. Exact same affordability calculation applies for our expat mortgages, so that being residential as UK applicants, and the same rental calculation as well on a buy-to-let basis. We can also look at taking foreign income as well into account. So what we'll do is we'll ask for the income in its currency, in its original currency, and then we will convert it into sterling. But then, yeah, it's the exact same affordability that would apply. Okay, so this is our family mortgage, our 95% borrowing product. So it's currently a 5-year fixed rate. So the reason why we introduced a 5-year fix was to allow us to stress it on pay rate if the applicants are falling slightly short on affordability on our standard stress rate. So how it works, so the applicants need a minimum of 5% deposit. This can be gifted from a family member if that's the case. That's absolutely fine. What we need though is we need some additional security from an immediate family member. Now the security is the value of 20% of the purchase price. And the security can be made up of 3 different ways, and you can mix and match the options as well. So first one being using property as security. This is the most common scenario for us. So the applicant's parents have a property that's potentially unencumbered, doesn't have to be, will go as a second charge if necessary, potentially even a third charge. We will then put a charge on the family member's property of 20%, and that's held for a maximum of 10 years. But we do review at the end of each product term as well to see if they've come down to 75%. If they have, the security will automatically be released. Same applies when using savings as well. So if the applicant's parents, again, have savings that they have sort of sitting there that they're wanting to use, but they don't necessarily want to gift it away because they won't see the money again, they can put it into either our savings security account and earn some interest on it, or alternatively, it can go into the offset account as well, which will actually offset some of the interest that the applicants are paying on their mortgage. Again, held for a maximum of 10 years or until the loan to value comes down to 75%. But most realistically, at the end of the 5 years, you'll then be able to remortgage them onto the high street. And then that releases any security that we hold. So you can use a combination of the options that I just suggested there. And we can actually accept up to 12 family members assisting for this. So parents, grandparents, aunts and uncles, and even siblings as well can come into place with this product. And we do offer 6 months unemployment cover free of charge, which I know with the current situation that we're in, gives that sense of security to the applicants, know that if anything did happen to their job, they'd be covered for 6 months. Okay, so alternatively from our 95% family mortgage, we've got our joint borrower sole proprietor. We call it joint mortgage sole owner, but it's exactly the same. So this is a maximum 75% loan to value. So this is designed for clients that have the deposit but are falling slightly short on affordability. So the parents then can come into place by going on the mortgage with them to boost up the affordability, but they won't be going on the deeds. So there is no additional stamp duty fees for the parents to do this. It can work in the same way of parents helping children. The children can actually help their parents as well. We're finding that sort of becoming quite common at the moment because clients that are with the high street are now having to remortgage but don't have the retirement income to support the mortgage, and they don't want to downsize and move out of the family home. So then the children are actually going on and helping them as well. So we don't have a set minimum income for this product. We do say that ideally we'd like the applicants to be earning 20,000. But how we view it is for applicants that could potentially then take over the mortgage in a few years' time, say. And then we become niche for this product is with our terms that we can offer. So it's a repayment product where the term takes the applicant's parents beyond 70, which then we can then do up to age 95 for them. Okay, so then we've got our offset mortgage. So this is designed for applicants that wanting to put their savings to better use. This is available on a residential and a buy-to-let basis, and they can offset up to 100% of the mortgage balance. On a buy-to-let basis, it can be interest only or payment. Say for residential, it is payment only. Money put aside for specific purposes, but don't money right away. So, for example, self-employed applicants that know they need to pay a tax bill, but rather than having it sitting there, not earning much interest or not coming to any use at all, they can put it to the offset account. They have and they can work at any time. It could also be for landlords as well that have the cash there to buy a property outright, but know that they may want to use that money for something else later down the line, or they may need to improve the property as well. So then it can sit in the offset account. They can put it on an interest only basis and they won't be making any mortgage payments at all. So it's available on a purchase and a remortgage, and family members can assist with this as well, as we can have up to 4 savings accounts linked to the offset mortgage. So I've touched base slightly on our buy-to-let mortgages. So we can offer a 65% loan to value for our buy-to-let mortgages. We can accept up to first-time landlords. As long as they're an owner-occupier, then that's something we can consider. We have no minimum income for our buy-to-let mortgages. So as long as we can get confirmation that they're able to cover 3 months mortgage payments if there was a rental void, then that is sufficient confirmation for us, and then we can proceed sort of without having to ask for that minimum income or evidence of that even. We don't stress portfolio landlords as well in the background, and no maximum number of properties that a portfolio can own. We'll just ask for a copy of their portfolio schedule, and they may have to complete an assets and liabilities form. But we won't be going through all of the properties with a fine-tooth comb and picking it all out. We'll just ask for confirmation of how many properties they own in the background. Limited company buy-to-let mortgages as well we can offer. Exact same loan to value as 65%, but if there are no personal guarantees in place, then we can actually consider 55% loan to value as well. Up to 8 directors allowed. They do all have to be UK based, so unfortunately at the moment we can't offer this to expats. But as long as all the applicants are residing here in the UK, then we can consider up to 8 directors. And then also it will work as a newly set up SPV with initially 3 properties in it. So yeah, that's all sort of the areas of lending. As I said, if anyone does have any questions, just feel free to ask. But on the specialist lending website, you'll find our decision principle forms, our application forms, and then details of our products as well. If you've got a case, that's a number to call at Specialist Finance, but please do feel free to call me as well. I'll be more than happy to run through any cases with you and help with any mortgages.
Okay, thank you, Grace. As it actually said, well, it said on there, I think Grace has gone to the questions page. Just give Grace a call. If you say Specialist Hub, she will then know that you're looking to come through us, and that way she's more than happy. Because obviously you have to be an accredited broker to go through them. But that's one way of doing it. Obviously, that also gives you access to the semi-exclusive products that they have that you have on your product guide that we've sent you. So, Grace, thank you very much. Okay, so on to the questions. I don't know if anyone's got any questions. No, there's no questions been asked. So, as always, we pre-prepare some questions. The first question is, can you consider RIO mortgages? And that's not mortgages in Brazil, obviously.
RIO mortgages. No. The RIO mortgages, it's up to 50% loan to value for our RIO mortgages at the moment.
Okay, and that is also within the product guide that we sent to all of you. Second question we do have one just being typed now by Steve. The second question I got is, what is your maximum age for your joint borrower sole proprietor mortgage?
So we can actually go up to, so it's maximum age 90 for our joint borrower sole proprietor, and we can offer a 5-year term for an applicant age 90.
Okay. And Steve Birkins asked, on expat mortgages, will you consider applicant resident in Chile?
Oh, good question.
I think you do, because I think
need to double check. Yeah, we had a recent change with our expat countries, so I need to double check.
Okay.
But I don't believe Chile is one of them.
Yeah, on the product guide we sent over, Steve, and everybody else, it actually I think it's on page 7, has all the current countries that they'll accept expats from. But I'm pretty sure we have other lenders that would accept somebody living over in Chile. So, but yeah, that is up to date as of, I think it was probably Tuesday morning I did that. So just to check, because there have been a couple of lenders that just like Gibraltar had disappeared, and a couple of others had gone off, but you added some new ones on. So, okay, so any other questions being asked? I haven't got any other questions. So no, we haven't got anything else. So Grace, thank you very much indeed, as always.
Thank you.
Lovely to see you again. It's nice to see somebody who can actually have a camera below them. If I do that, it looks like I've got about 14 chins, unfortunately. So that's why the camera's so high.
I don't believe it.
Actually, no, we do have somebody just typing something now. We'll just wait on that to come through just in case it's a question.
Okay, perfect.
That I can't. So we have Paul typing right now. No pressure, Paul. No, nothing. It's not appeared as yet. I think he's still possibly typing. There it is. Can your expat come from different countries?
So really, for an expat, mortgage for us is a UK national that is living and working overseas. However, if one of the applicants is a UK national and they're married, then we could potentially consider that. Okay,
and also we just point out, Paul, we have honestly loads of lenders that will accept that type of scenario. I mean, there's only very few countries that we can't actually arrange something, but it's going to be your normal ones: Yemen, Iraq, Syria. You know, the ones that you would expect, and any country. Try something from North Korea, then you're probably wasting your time. But okay, and Paul just typed something again. So I mean, there's very few that's on. There is something online that we use quite a bit that if you need a link to, we can send that over to you, and it just shows the sort of level of problems that the Foreign Office believe that particular country. I don't know, it is the Foreign Office actually. I'm not sure which government department it is, but whichever government department it is, they actually give a grading. So you'll find the likes of Syria will be right at the bottom, and obviously some places the EU will be right towards the top. Paul said he has 2 in the US and 1 in the UK, all directors of the same company.
I don't think we're going to be able to consider that on one mortgage, because it'd have to be married applicants, and one as a foreign national that we could potentially consider it. But if it's 3 applicants and they're not sort of related at all, then it's probably unlikely that we'd be able to consider it.
But
maybe
Paul, again,
give me a call about that one, and we can go through that.
Sure. Yeah, we do have other lenders. I know we'd definitely do that. So. Okay, so 10:42. So Grace, you're ahead of schedule. Thank you very much indeed, which means that we'll say goodbye to you now, and I will now put up the next set of slides. No, thank you very much. Appreciate it.
Bye.
See you. Okay, so next speaker is the very handsome James Briggs, as you can see from that photograph, probably professionally taken, I'd say. And known James for a long time. Lovely guy. He actually looks like that the whole time, by the way. I've never seen him without a smile on his face. I don't know what he's got to be so happy about, to be honest with you. But anyway, so everybody, what you're looking for is this. James will be talking today about bridging products, but mainly he's going to be focusing on regulated bridging, which is something I know is more and more prevalent at this moment in time. Hi, James, can you hear us?
I can hear you. Can you hear me?
Absolutely, yeah, absolutely. Wonderful. Loud and clear, no problem at all. So, so James is focusing on bridging, mainly on the regulated bridging side. So I always say we always try and put across different products on each of ours. We do have a bridging lender speaking later, but it's on a different type of bridging. So this is one you're looking for, been sent you by email. Even those of you that have signed up since 10 o'clock, you now have this on your email. So check your spam if it hasn't come through into your inbox. So. A little bit on James. He's worked in the special lending sector since the late 1990s, a wide variety of lenders and distributors. Joined Precise in 2013 to help build and launch the second charge proposition, and today spends the majority of his time helping to grow awareness of the benefits of specialist lending for intermediaries, managing relationships with key distributors, and developing the Precise mortgages proposition. He's also great fun to be with, by the way. He's got a great sense of humour, but that's, yeah, just a really nice guy, James, really is. So on to his interesting fact. As a child, James Rotar accepted to appear on Jim Will Fix It. Fortunately, these are his words, not mine. Fortunately, he was on a family holiday for the scheduled recording. So there you go. That's the most unusual one we've got out of all the speakers, I must admit, is somebody who was going to be going on Jim Will Fix It. Okay, so James, over to you. And hopefully your slides will work this time. The last time James did a presentation, his slides were back to front, and we had to actually do it on my screen with me clicking the button. So James, over to you.
Thank you, Tony. Yes, I can confirm that was a professional photo, and they could not do anything about my chins on that, so I suffer from the same problem as you do also. Morning, everyone. Thanks for having me on today, Tony, and thanks to everyone for attending today's session. As Tony said, I've had a relationship with his business in various different guises over many, many years. Him and his team do a really, really good job for us, very reliable, very well packaged cases. And because of the level of business and the relationship they have with us, they get enhanced commission. So that means you're not going to earn any less by going through Tony than coming to us directly. So you can tap into Tony's lender panel. He can decide what the best lender is for your client and their circumstances, and you're going to earn just as much as doing the case directly with us. So hopefully that gives you an incentive to use those guys, because they do a really good job. So yeah, James Briggs, I cover bridging finance for the North and second charge loans for the whole of the country. Going to focus in today on regulated bridging, which we're seeing a lot of at the moment. We'll go into the different reasons around that. Hopefully you guys are all familiar with Precise Mortgages and our brand and what we do. We're well known as a specialist lender in the buy-to-let and residential space, but we're more considered a high street lender in the bridging space, because we have some really competitively priced products and excellent service that sits along that. So today we're going to be talking through some of the opportunities when discussing bridging with your clients, and what to look out for, and hopefully we can work together on some of those opportunities. So we'll click onto the first slide. There we go. Now, if I say bridging finance normally to a room of mortgage brokers, there's sometimes a sharp intake of breath. And I'd just like you to think for a second about what the first thing is that comes into your mind when we mention or talk about bridging finance. So feel free to use the comments if you like, or just have a think. I'll give that a couple of seconds. Fear, I like it. Okay, we'll go with fear. So the fear is one of the top three, actually. So first one is fear. So am I going to lose the property? Am I going to get trapped in a bridge? Second one would be cost. It's expensive. And the third one is complicated. I don't really understand. You know, it's quite a specialist space. I'm not really that comfortable doing bridging. It's outside my sphere of expertise or comfort zone. I think they're quite common misconceptions. So bridging finance is a needs-based solution like any other mortgage product. Yes, it's more expensive than a term mortgage, but it's a really useful tool in a broker's armory to help clients out at certain parts in their, in their life cycle and their borrowing cycle. It doesn't need to be expensive if used in the right way when compared to some of the alternatives as well. For me, bridging finance is all about putting clients in a proceedable position. So putting them in that A1 position to do what they want to do now and not being reliant on other third parties. And our average case size on bridging finance is £225,000 at the moment. So there's some fantastic income opportunities as well as helping clients out where a traditional mortgage potentially wouldn't do. So if we look at the top 5 reasons for using bridging, so it can help any borrower who's got a short-term need for funding. Okay, so what we're seeing a lot of at the moment, we've got a case study on this, is older borrowers looking to downsize, maybe because they're feeling isolated because of COVID, or they want to go into some serviced accommodation, old people's home, or just be near family members. Bridging facilitates them to be able to do that now without having to wait maybe 6 months to sell their existing property. Really useful for homeowners and landlords who want to renovate property. Particularly landlords. I'm not going to talk about the non-reg investment side too much because you've got MT on this afternoon, who are a fantastic bridging lender also. But they can be used to renovate investment properties before clients put them onto a 5-year fix, before clients go onto a 5-year fixed mortgage. So maximising their borrowings before locking in on a medium to long-term fixed. Really useful for clients who are looking to buy at auction. So when the hammer falls, typically there's 21 or 28 days to complete the purchase. Very difficult to do with the timescales of existing lenders in the first charge world, but easily achievable in the bridging finance world. If a property is going through auction, chances are there's other issues, so it may require a level of refurbishment, or some work needs to happen to the title or the structure or whatever. Another common misconception about bridging finance is it's just for property related transactions. So yes, we do need security in terms of residential property in the UK, but the purpose can be used for any legal purpose in the UK. So we do a lot of bridging finance loans for business use and for clients who need to settle tax bills where time is of the essence. So those clients who need to capital raise quickly. And of course, a big one, very, very prevalent at the moment, is chain break finance. Me personally, I've just gone through a sale and purchase of a residential property. We lost our first 2 buyers on the sale of our old resi, who came to us with 90% LTV first charge dips, which when they applied, those products weren't available anymore. My wife had already fallen in love with our new home. So bridging can be used to move on with the onward purchase and complete the onward purchase before you've found a buyer for your existing property. Okay. And that is a real strong selling tool at the moment, particularly with the stamp duty holiday, because clients can offset the cost of the bridge with the saving that they're making on the stamp duty to get comfortable in their own mind and help them secure the home that they're looking for. Okay, so in summary, when we say standard bridging, we're talking about a bridge where no improvement works need to be done to the security property. So it's habitable and it's mortgageable currently. So to summarise, where the funds are needed quickly, clients looking to downsize, auction purchases or any other legal purchase, chain break finance, or landlords looking to make a quick purchase. Okay, so here we have an example of a fairly typical downsizing standard bridging case. Here we have a chap, Mr. Parker. He's found his dream home, maybe closer to family members, in a popular location. It's just come on the market. He's not even thought about putting his property on the market, but he's seen something that he's fallen in love with. His current property is worth £500,000, unencumbered. The new property is worth 200,000. So it's your fairly standard downsizing case. So the client really has got, assuming that they haven't got 200 grand sitting in the bank to be able to make an outright purchase of the new property, clients like this usually have 3 options. They can cash in investments to make the purchase before selling their existing property. Usually that can attract a CGT bill, which could be substantial, and also clients might be reliant on those investments for future pension income. They could discount down heavily the price of their existing property to try and find a buyer quickly. That's a lot of people's default position without even thinking about bridging. So I've got a 500k property here. I want to sell it quickly. I'm going to put it on the market for 460. Hopefully, by the time I find a buyer at that competitive price, the 200 grand property that I want to move to is still available. Well, potentially the customer's going to be sacrificing 20, 30, 40,000 pounds in value in their existing property. Or they can utilise regulated bridging finance to make the move. So we'd want the existing property on the market at completion, but we'll give them up to 12 months to sell that property. So that means they can achieve full market value for their existing property, but it means they can secure the new property that they've fallen in love with. And on our regulated and non-regulated transactions, currently all of our interest is retained, so the clients don't make any monthly repayments. Okay, so how much is that going to cost the client? Well, we'd set up in this scenario a facility, a total facility of 216,663, as it says on there. Because of the equity in the client's existing property, we'd just be charging the existing property. So the place that they would be buying would be unencumbered. And because of the LTV, that would attract our headline interest rate of 0.49%. So we'd release 200,000 for him to purchase the property. Our lender fee on that would be 4,750, and the interest, assuming that the loan ran for the full 12 months, would be 12,343. So the absolute maximum it's going to cost this client is 16.5 grand. Now, it sounds like a lot, but if they were to discount down the value and the asking price of their existing property to find a buyer quickly, chances are it'd be a lot more than 16,000 they were discounting it down by. And also, we calculate our interest on a true daily basis on our bridging finance cases. So the clients only pay interest for the amount of time that they're using the bridging loan for, back to the day. So you've got some examples, if the loan was to be settled early, of how much the true cost would be in interest for the client. So 6 months, it'd be just over £6,000 in interest, 9 months, just over £9,000. The average term that a client sits on a bridging loan with us for is between 4 and 5 months. Okay, so when brokers say to me bridging finance is expensive, it's useful to put it into context for what it's allowing the clients to do. Yes, it's more expensive than traditional mortgages, but look what it's allowed this particular client to do. Okay, so our bridging is segmented into two regulatory areas. So we have the regulated side, which is what we're talking about there. That is a 12-month maximum term. So we will calculate the total interest for 12 months and factor that in when calculating the loan to value. The current loan to value on bridging finance is 65% maximum, a little bit lower than where we were pre-COVID, but we will be stepping that up as things hopefully start to get back to normal early next year. Those cases are regulated by the FCA, so you will receive all the appropriate documentation and you guys will give the appropriate advice on those cases, and that covers consumer buy-to-let as well. We also do the non-regulated bridging cases where it's investment property purchases. The terms on those can be up to 18 months. So it's a longer term on non-reg, just to allow time for clients to do the work to the said property, investment properties. Also gives some allowance for delays in tradespeople, materials, which if you try to buy anything from B&Q during the first lockdown, you'll know that it was an absolute nightmare trying to get hold of material. Between the two, historically, we've always run at about a 50-50 split between the two. Currently, though, we're about 65% regulated, so about 2/3 regulated, 1/3 non-regulated. Some of that is because of the strength of our proposition and service and the partners that we work with, like Tony, but a big part of it is the market that we're living in. So it's very competitive in the purchase market at the moment. The stamp duty holiday is looming, the end of that is looming. People need to be putting themselves in those proceedable positions. If they're going to an estate agent and they've fallen in love with their house and they've got somewhere to sell, they're not going to be a great prospect for an estate agent. So bridging puts people in that proceedable position and means they can go. Okay, the second strand to our bridging alongside the standard is light refurbishment. So what do we mean by light refurbishment? So it's really internal refurbishment to a property. So plastering, electrics, new kitchens, new bathrooms. What we can't do is where there's an overall change in use to the property. So if the property is currently commercial and the clients want to convert it to residential, that's out of scope of our lending at the moment. Anything deemed uninhabitable by a mortgage lender is absolutely fine. So we've probably all seen those mortgage valuations come back where it's not suitable security. Bridging finance can help out with those, but it's the conversions that we can't do at the moment. So things like large houses to HMOs, large houses to multi-unit freeholds, where you're changing the makeup of the property, or extensions. They're out of scope at the moment, but they will come back because we were very active in that space pre-COVID. We've just got a couple of photos here from a light refurb that we had in last year for one of our clients. Not sure if this was one of Tony's brokers or not, but this was a repossessed property. So we did this on a light refurbishment bridge over 18 months, although the work was completed within 3 months. So an experienced property developer purchased this repossessed property at auction. The previous owner had, out of spite, like a lot of them do, absolutely stripped everything out of the house. Light switches, plug sockets, absolutely everything. So it was actually a blank canvas for the investor in this case, and went in there very quickly and got the property up to a mortgageable state, and no doubt put it onto a longer term fix on a buy-to-let and capital raised as much as they could for future. They don't all have to be as severe as that example. We do see a lot of cases going through the auctions where they just simply fall below the EPC, minimum EPC rating of E. So technically are unlettable and unmortgageable. And to get something from an E to a D or a C can be as straightforward as double glazing and a new boiler, which is work that can be done very quickly and relatively inexpensively as well. So back to regulated bridging then. Here we have an example of a light refurbishment bridging case utilising cross-charging. So very common in the bridging world to cross-charge, i.e. take security over multiple properties, which we can do, combination of first or second charges. So we've got a couple, Mr. and Mrs. Older, they want to move on up the property ladder, purchase something a bit bigger that needs modernising. They've fallen in love with the place. They want to keep their existing property as a buy-to-let, so they're going through the let-to-buy scenario. The current resi is worth 160. It's got a small mortgage on there, just under 40,000. The target property that they want to purchase is valued at 250. It needs £50,000 worth of work doing to it, and they need to borrow 200,000 to buy that property because they've got 100,000 in savings from an inheritance that they had last year. So 65% LTV bridge with us, secured on both properties. So a first charge on the place that they're purchasing and a second charge on their existing property, structured over 12 months because it's a regulated case with a monthly interest rate of 0.69. So this allows them to purchase the new property, gives them the time to complete the works. In the background, while that's happening, the broker's completing the let-to-buy mortgage, capital raising on the let-to-buy to 75%. Clients can then pay down the bridge with the capital raised on the let-to-buy. And when the work's completed to the property, they can remortgage it using the afterworks value and clear the remaining balance on the bridge. Okay, one of the cornerstones of bridging finance is exit routes, which you'll know if you've ever been involved in bridging. All responsible bridging lenders should get to understand what the client's exit route strategy is. So how are they going to pay the bridge off? At Precise Mortgages, we're really flexible about what exit routes can be used. So we can accept a refinance to another Precise Mortgages product. And there's an advantage for the clients doing that because we will let them revalue the property even if they've only owned it a month, and we'll allow them to remortgage using the afterworks value. They can refinance to another lender, whether that be on a residential or buy-to-let basis. They can sell the security property, so they might want to do work to the property, then market it for sale and clear the bridge that way, and make the profit in the asking price, or sale of another property in the background. Those are acceptable, as is any other sensible exit route that we can validate. We are seeing a lot of equity release mortgages being used as exits currently, and also divorce settlements can be used as exits, as long as we can just understand how the clients are planning on getting out of the bridge. That's that and the LTV are the key considerations. So on Tony's website, on the hub, you will find our DIP forms. So DIPs are being worked within 4 hours currently, so you'll get a fast response from our underwriting team. We're fortunate to have 75% of our underwriters now working back from the office, socially distanced, of course. If any work requires to be completed to the property, so if it's a light refurbishment case, we will always ask for a schedule of works. That can be on our document or the client's own Excel document. We're looking for a breakdown of what they're planning to do to the property and what cost they've associated to each of those items of work. Just to understand that it's achievable within the time frame and it's achievable within the client's budget. And we may ask for evidence of the exit, but most of the time, if we can see that it would fit on a refinance, either residential or buy-to-let, then we will get comfortable with that in-house and you won't have to prove an exit to us. Okay, just wrapping things up then, final couple of points. We, unlike most bridging lenders, we offer joint legal representation. So the clients only need to appoint one lawyer on our Premier panel, and they will represent us and also the clients. Two big advantages of that is it saves the client typically about £900 in legal fees per transaction, but it also speeds things up greatly, so you haven't got solicitors communicating with each other and those associated delays. You can access our long-term products, whether that be residential or buy-to-let, after just 1 month using the afterworks value. So really useful for people who are planning on completing works within 6 months. We will take additional security, so a combination of first and second charges, and we're one of the few bridging lenders that will take third-party security as well. So we can accept security towards our bridge that isn't held in the client's name. So if your client's got friends or family members who maybe can't help out with a cash injection but have equity in their house, we can take a charge on that as well. And those people don't need to be co-borrowers on the bridge. They're just providing third-party security, so they have ILA. As I said, interest is calculated daily, so it's the fairest way of doing bridging finance. We don't have any exit penalties, and we can do AVMs as well. So up to 50% loan to value. As long as the confidence level's there in the background, we don't even need to send a valuer out to the property. So that can, again, save time. The client's going to set up costs and money. And that's everything. So I'll hand back over to our presenter extraordinaire, Tony Sutton.
Called many things. Okay, so just as it says there, any documentation you need, just go on to our website. It's got Precise's marketing partner, probably the most active in the marketplace. They've seem to have documentation for literally everything, including the COVID-19 documentation. And I was looking last night, and there was just stacks of it for each product they offer too. So any of the documentation you need, just or of course, if you just want to pick the phone up, we have a dedicated telephone number for Precise, which is a free phone number, and also the dedicated email address for Precise as well. So just send us something over on that. Okay, we've got a couple of questions, James. There's no questions so far. I'm just actually going to what Dean said earlier on when he mentioned fear. The number of introducers that we have who are very active in the first charge market, regulated first charge market, when it comes to bridging, there really is this sort of like, just really are, they're petrified of it. So it's something that we're certainly not petrified of, because we've got the tools in place to be able to ensure that we're compliant or anything else. But I do understand some of you when you say it's something you don't want to touch because you worry what might happen in the future. Well, we can talk about that a little bit later. Alan Smith has asked a question of you, James. What is your appetite for lending in Scotland?
Yeah, so we do bridging finance in Scotland. It is postcode restricted, so we can't do the Highlands. So we can't do Inverness and Perth. I know there are some gorgeous properties up there, but it's just the the market is a little bit more limited for exit routes there. But the kind of, if you draw a line between Edinburgh and Glasgow and work your way downwards, we're more than comfortable lending in all of those postcode areas.
Okay, we've got some questions. There's no other questions being typed, so we've got some questions here for you. Realistically, how fast can a bridge be completed?
Okay, yeah, good question, whoever came up with that. So the auction finance ones can be completed really quickly because there's usually local authority searches in place already. So it's not uncommon to get those to offer in 3 or 4 days and complete them within 10 days. We do title indemnity on refinances. So if the properties are already owned by the clients, we've got search indemnity there. So they can be completed within a couple of weeks normally. But yeah, it's very, very typical. On average, we're looking at about 20 days. And
please be aware, people, that when you see announced in the financial press that such and such packager, broker, specialist finance, whatever they want to call themselves, has just completed a bridge in 4 hours, that isn't the norm. They really is a once in a blue moon type situation. Really normally, I mean, the quickest we've done one in recent times, which was a regulated bridge, was 3 days, and we had 4 days to complete it. But normally you'll find that 3 weeks maybe. But if there's a purchase involved, then obviously there's always difficulties with the purchase when it comes to solicitors because they've got to justify their fees more than anything else. So other questions we've got is, why are you not currently offering heavy refurbishment bridges?
Yeah, so I think I kind of covered that off in the presentation. So it's just around the availability of tradespeople and materials at the moment. So that's an area where we will get back to when the dust settles, when the COVID dust settles. But that will probably come kind of end of quarter one, quarter two next year. No plans to go back into that immediately.
Excellent. And will Precise be reintroducing the combined refurbishment buy-to-let product?
Yeah, okay, so that was a really popular product where we underwrote the bridge and the buy-to-let exit on day one. So the customers had the confidence of the exit in place before the bridge was even completed. So kind of answering the concern earlier on that Dean had about fear. Again, that's quite a time-sensitive type product, so it's not quite the right time to reintroduce that product yet. But we have every intention of bringing it back, and we are working on that and bringing that back soon. So that will give those customers and brokers who are a little bit concerned about the exit route, that will give them that ultimate confidence to go for bridging. So I think probably January, February we'll be looking at
it was a great product.
That.
Really was a great product. Yeah. Okay, no more questions. So, James, thank you very much indeed. Precise really are, I mean, for me, probably in normal times, they are the go-to lender when it comes to certainly regulated bridging and unregulated in many cases as well. They really are, because service-wise, product-wise, it's just they are second to none, in my view. And as James mentioned right at the start, if you come through us, you earn the same as if you were to go direct because we have packager status. And that's across all their products as well. So not just the bridging, but also the buy-to-let and the second charge side as well. So, okay, James, we are almost bang on time. It's 12 minutes past 11, so there's no other questions. So, James, thank you very much indeed. Great to see you, and we'll speak soon.
Thank you very much. Thanks, everyone.
Cheers. So, just a little bit on Luke, first of all, is BDM for YBS Commercial Mortgages. Having had roles in marketing as a relationship director, Luke has a broad range of experience, which he uses to support the YBS Commercial Mortgages broker panel and wider business development activity. He has a keen interest in the commercial finance market and in relationship building to support YBS's ambitious growth strategy of expanding its award-winning product range and opening new regional offices across the UK. I'm just actually going back to your photograph, Luke, because you look very different in that photograph. Just let me have a quick look. There you go. Look, so bit what we call this COVID hair, I suppose, don't we? But I had my hair cut on Monday. It was an absolute nightmare trying to get an appointment. But wasn't going to go through what I went through back in the summer. I had a mullet by sort of like the end of May. So yeah, looking very different there. So Okay, so Luke's interesting fact, loves surfing and visits Cornwall every year. I shouldn't imagine we're doing too much of that at the moment, to hone his skills, although this often just means perfecting the art of getting back on his board after he wipes out. Something I've never tried, and I must admit, something I never will try, surfing. So, Luke, it's on to you. You have control of the board, so over to you.
Thank you, Tony. Pleasure to join this morning, and thank you for that introduction. It's great to be able to speak to you all today, just a chance to run through our range of products and give you an overview of where YBS Commercial have come from in this last year. I think, as Tony mentioned, we were formerly NMP, Norwich and Peterborough Building Society, and the commercial division there, rebranded last year and came into the fold. And that's meant quite a bit of change for us. So we've opened new offices in Birmingham, Bristol and Manchester. We've always lent across the whole of England and Wales, but this is just to give us a more local footprint, expand our expertise, and to bring in more colleagues to the society as well to be able to support. So happy to be able to give a run through today on our key products that we've got on offer. I'll start off with the corporate buy-to-let product that we've got in place, and this is available for limited companies and LLPs. From the start of this year, we've moved on to a fixed rate pattern, so we have 2 5-year fixed rates available and a 10-year fixed rate product that are on there. Pricing, as you can see on your screens, hopefully, we believe is strong competitive feel, and these are for experienced landlords. So we're not lending to first-time landlords at the moment, typically people with 5 years letting experience or 15 properties in their portfolio if it's less than that. We can consider lending to people who have less landlord experience than that over the period, but we'd probably be capping that at £2 million lend. Our loans start from 500,000 across our product range, going upwards to exposures of up to £15 million, depending on the split of products that are being taken. You can see the stress rates that are on there. It's effectively a 0.75% loading on top of the pay rate for each of the products. We found that allows us to gear to the 75% mark, even in low yielding areas. So we're quite pleased that that's working for us. And this is available for your standard AST type let property. So we're not looking at HMOs at present. We will consider multi-unit freehold blocks where you've got individual access to each of the flats. We'll consider up to 20. Appetite typically tends to sit up to 12 units in a single block. Beyond that, we're happy to consider, but we're looking for those to be in key conurbations, so typically city-based, where we can see that level of demand for reletting if there were any voids to appear. I see 1.25% arrangement fee that goes in place. Happy to do full-term interest only for all of these loans, but we can consider part and part up to a 50% split, or a capital and interest repayment loan if that suits the client's needs as well. Mentioning on this as well, the 10-year fixed rate, we believe that's a really positive offering to bring into market. It's something that we haven't done previously. It's not for everyone, because we know some people like to have that flexibility, and there are ERCs throughout the full term on both of those products. However, for people with portfolios that they're looking to have that level of certainty, particularly at the moment with a lot of unrest in the market, that's proving popular with a range of our customers. Something else that we've added into our product line is the large personal buy-to-let. Now, traditionally, we've always lent to the limited company and LLP market. We have a sister company, Accord, which I'm sure many of you will have heard of or perhaps worked with, who are part of the Building Society, that work on our higher volume, lower end property mortgages. We've been able to bring in our own personal buy-to-let offering, but for those with a larger portfolio that's in place. We know many people have gone down the route of incorporating their portfolios into a limited company or via LLP. However, that isn't for everyone, and the capital gains tax position and the other implications mean that for some people, they want to retain those personal buy-to-lets in their own name. So as long as they have 6 or more properties, and we're looking at a minimum loan size of 1.5 million in this instance, we're happy to consider those. or if there's less units, but we're talking about a higher loan size, so starting at £3 million, as you'll see on the screen, then we're happy to consider those. The cost for it is exactly in line with the corporate buy-to-let product, so the same margins at 5-year and 10-year, and just to confirm the differential, up to 65% loan to value on the 5-year fixed is the cheapest rate at 3.35, but we will do up to 75% at the 3.55. Similarly, it's the same property types that we're looking at, so this will be houses, flats, bungalows, your typical asset classes, bricks and mortar, which are let on a standard AST basis. As with the corporate buy-to-let, we will consider some types of approved corporate letting agreements. So that would be for residential use for the properties. And again, interest only available for the full term across all of these products. Something that we found a lot of people have been interested in the last year are new build flats. Previously, we wouldn't lend to developers. For some reason, the society had a concern around the way that the risk factor that implied to us. That's no longer the case, and we welcome developers with open arms, as long as we can see a positive track record and that performance history. So this is perfectly fine for people who have a development build they're looking to retain. We can look to give that term exit for their development finance that's in place, but we can also use this for individuals or investors looking to acquire new properties and building off plan. The properties have to be in a lettable condition at the time that we lend, and we'll consider up to 65% on these products. So that means that the 5-year and the 10-year fixed rate are available, but capped at the 65% mark. Something to call out on this element, we know that office to residential are unacceptable. For us, that's really looking out for the large office builds that have perhaps been converted through permitted development. We tend to focus on smaller, higher quality schemes, not to infer that there is a lower quality, but it believes we get a greater amount of control over the type of assets that come in. If we've, say, got a retail unit that had office space above, and a single office has been converted to residential, please feel free to inquire with us, because there's something that we can look to do there. It's typically the larger builds where we'd have more of a concern, or our credit team would at least. Just to call out on the ground rents, probably something that's quite common at the moment with it being quite hot on the press. We have up to £1,000 per unit as a maximum cost, an uplift no greater than RPI CPI that's in place. So none of the ones that are doubling every 5 years and impacting future capital values. We have had a new addition to our product range during the summer. Obviously, we're seeing that more people are choosing to staycation in the UK, whether that be by choice or by circumstance at the moment. But it's certainly a route that we're finding investors are finding an attractive option because of the yields that it presents. Of this product, again, it's a 5-year fixed rate that we'll do on interest only at a rate of 3.85%. This is for standard asset types, so again, houses, flats, of bricks and mortar construction, and properties that could effectively be let on an AST if that was an option. So we're not looking at the lodges or trailer homes or anything on that basis. It's a standard property. And the part to call out here is that it's an affluent coastal and national park locations that are being considered. Originally, we launched this purely out of our Bristol office that cater for the southwest of the country, but we have expanded to all of our offices that are able to present this product now. And as long as we can see that it's a regular holiday location, so not for use in the more weekend-let city centre break, it's for those traditional holiday-esque areas that we'll look at. Something to mention, again, it's a £500,000 minimum loan size. Part of the reason we bought this product in was to give flexibility to those people that have a buy-to-let portfolio that contains some holiday lets. Rather than having to chop and change between different lenders, we'd be able to cater for the standard element as well as the holiday let. We'd do that as 2 separate loans, but we could onboard at the same time, and it'd be the same dedicated point of contact in the relationship director that's able to carry those loans forwards, making it a much swifter process. Now, we know for holiday lets, people have been impacted. There was a lockdown, it stopped people travelling, it stopped some of the holiday activity that was expected. So as part of that, when we look at affordability for existing holiday lets, we'll take the track record of the 12-month period prior to the initial lockdown, so that we're not impacted by change in activity that occurred after that. Now, we are open to purchases as well, where you won't have the track record or necessarily the bookings in place. Someone could be buying a standard property that's been vacant or owns a private resident or less than an AST, and we'll use our valuers' guidance on that point to be able to give us a gross rental figure. We deduct letting agents' costs. If we're not aware what they are, we make an assumption of 17.5%, and we'll subtract business rates if they are payable, which typically only comes in if there's 2 or more holiday lets within the owner's portfolio. That net income, 125% stress rate, the greater of 5%, or pay rate plus 1%. At the moment, that would be the 5% figure that we're working to. Again, 1.25% arrangement fee, and we are able to look to add the loan across the board on any of the residential investment style products, as long as there's serviceability to be able to afford that additional amount. I'd like to bring us on to commercial investment offering that we've got at the moment. We've been able to continue lending throughout 2020. We'd never fully pulled back from the market. At the time of lockdown, we did retrench on some of our criteria. It seemed like the sensible thing to do, given circumstances and the reactions of other lenders. But we have been committed to staying in place. At the start of the initial lockdown, we were still continuing to lend into the retail space in what we classify as essential retail, so convenience stores, supermarkets, opticians and alike. But we've been able to move back into lending on a wider range of areas as well. Industrial, another asset class that we continued lending on, and we will consider loans up to 75% on industrial asset types, as well as semi-commercial properties where there's a residential weighting, and we deem that as 75% or more of the rental income coming from the residential arm of the property. We will look at semi-commercial where there's a more commercial heavy split, but would be capped out at 65% loan to value, as you can see on your screen. The areas that we don't really touch on are hospitality, leisure, restaurants at the moment, and any specialist leisure. Those are never areas that were our key drivers for the business, and rather than half-heartedly be in place or turn people away, we've pulled back from that area of the market completely. We still will lend to cafes and coffee shops, and at the moment we've had no change in respect of the current lockdown that we're facing. So I'm hoping that this criteria will stay in place, and with the turn of the new year, hopefully we may even be able to edge up in some of the other areas on loan to values. But we're keeping a watching brief on that as we're informed from our risk colleagues who are keeping a close eye on matters. With the commercial loans that we offer, we charge 1.5% arrangement fee. Again, we will look to add this to the loan, serviceability dependent, but we can't exceed the loan to value cap. So a 75% loan to value lend on an industrial unit would need to incorporate the 1.5% fee that's being added if that was the option for the client. In terms of repayment methods, in most instances, we'll find that we'll be looking at a capital and interest repayment term where we'll fully amortise the product. However, depending on the starting loan to value and what residual debt position will be at when it comes to first lease break or expiry, we may be able to look at doing an interest only option up to a maximum of 5 years, and that could revert to a repayment profile thereafter. Otherwise, a part and part style transaction up to 50% interest only with 50% capital and interest repayment. And part we see is quite common on semi-commercial style assets, where we can put forward an argument that the residential element would normally be on an interest only basis when onboarded in other circumstances. Stress rates included on the pack. So we look for 100% debt service cover. That would be the same even if we're looking at an interest only loan using a stress rate of 7.25% or pay rate plus 3.25%, whichever is the higher. Something to call out on this, we lend against the lower of purchase price, market value subject to tenancy, and market value with vacant possession, and that's across the board. The only instances where we would sway from that are if we have 100% of the rent coming from a blue chip tenant, so a national brand with a D&B score of 4A2 or better. But for mixed units or where we've got an array of local tenants, we'd be looking at the lower of those values. You can see on there that we've called out our ideal inquiry. That's not to say that's going to be for every loan. Similarly with these, 500,000 is our minimum loan size, and we are again looking for experienced investors. Now that could be people with investment experience solely in the residential buy-to-let market who are now moving into commercial, but we do need that element of letting experience. Just like to demonstrate the owner-occupied element of our product range as well. In terms of the asset classes that we'll consider, it's exactly the same as on the investment. Anything industrial, weighted semi-commercial, we can look up to 75% and 65% for an array of other asset classes that are in place. We charge the same arrangement fee. The key difference is the way that we calculate affordability that's in place. We will use EBITDA as an average over the last 3 years for the company's performance. That's 100% debt service cover we're looking at. Again, 7.25% or pay rate plus 3.25%. Now we will add back rents in place, and that's not only trading rents if someone's purchasing their own premises, we'll also add back any investment rents that are due as part of the property. So if someone operates from one industrial unit but they let out the neighbouring unit, we will still include that investment income when we're calculating where we can gear to. We know that a lot of our competitors don't do that, and that can set aside mean that we can get to those higher gearing positions. Something we'll consider with owner-occupied properties is any key man risk, particularly at the moment. So we'd like to see that there's a level of management structure in place so that if someone wasn't able to continue working for a period of time, that there would be someone else or a team in place that would be able to support the operations of the business through the months until that person could return or after they exited the business. We'll also look at the performance, and this applies to the investment loans as well through the COVID period. So we'll be inquiring as to what's happened in terms of business or rental flow. Have there been any payment holidays? Have there been any CBILS that have been taken or bounce back loans? And we don't have a red line in place that says that we won't lend in any of those circumstances, but we're a relationship-based business, and we'd always like to have a strong understanding of what's happened with that individual, what's happened with that company, so that we can track forwards and be able to demonstrate to credit that we're looking at a sound risk to be able to take deals forwards. This latest slide gives a bit of an overview of our exposure levels that we can go to. We're happy to go to £15 million for new customers to this society on any of the corporate buy-to-let or holiday-let exposures. At £5 million into a first loan, we can lend up to 75%, but anyone looking to borrow above that, we would be capped at 65% in the first instance. After someone's been with us for a 3-year period, we do unlock that and we can lend up to £20 million as an exposure. We'll also consider lending up to 75% against the larger portfolio that's sat behind it. This tracks similarly to the other items in place. The cumulative total is shown on the right hand side, and just a reminder, no first time landlords I'm afraid at the moment, and the non-professionals capped at a £2 million exposure. Thank you everyone for listening. That's a bit of a quick canter through. Hopefully it gives you a view of the spread of products that we have available at the moment, and by all means we look forward to hearing from you.
Luke, thank you very much. If any of you have any questions, if you could start typing now, that would be great. I've got a couple that we prepared earlier for Luke, which first question I got is, do you lend in Scotland, Luke?
I'm afraid not. England and Wales at the moment. Whether that will develop in the new year, we'll see, but unfortunately not at the moment.
Okay, further questions I've got. Oh, Caroline has just put something up. So for buy-to-lets, will housing association lets class as corporate clients where they guarantee the rent?
So in respect of housing association as a tenant, that can be considered in some instances, guaranteed rents, and we'll consider those on a case-by-case basis and depending on the length of lease. So we will look at that. We do have a dedicated housing association arm to the business that works on properties owned by housing associations, which would be a separate matter, but yes, happy to consider.
Okay, Caroline's typing another question, so is Paul. So just whilst they're typing, I'll just ask this. Does YBS Commercial Mortgages have any plans to extend its product range?
Thanks, Tony. We have got a couple of plans that are in place. One of those that I'm hoping to see come in before the end of this year is a dedicated 5-year fixed rate product to apply for semi-commercial property. Again, this will be targeted at properties where 75% or more of the rent comes from a residential arm, but we're looking at an interest-only 5-year fixed rate on that. And beyond that, going into the new year, we're also in discussions with our credit and risk teams about bringing in an HMO dedicated product. It's not something we offer at the moment, but opening up that avenue to people letting to either professionals or students is something we hope to bring in Q1.
Excellent. Paul Rhodes, hi Paul, has asked multi-tenanted freehold block self-contained flats.
Absolutely fine, not a problem, Paul. We see lots of MUFBs. We lend on those regularly. Just something to mention, if we have 5 or more units within a block, we will look to get a block value from the valuers. Typically comes back discounted to some extent, but we believe that's fairly commonplace.
Okay, and Caroline just added, maybe I asked the question wrong, I don't know, not owned by housing associations, she has clients who rent to housing associations, which I think is what you answered anyway, so I think...
Happy with that, Caroline, thank you.
Yeah, and one final question I've got, nobody else typed anything, no. What is the process for progressing a loan through YBS Commercial Mortgages? Just before you answer that, Luke, I will say that YBS was probably the second most difficult agency that we've ever had to actually get on board. I honestly at times felt like I was given my medical history along with our trading history. It really was. It was tough, really tough. And I know a lot of brokers who'd love to be on board with them can't get on board with them. So I believe it's still a restricted panel, I would presume, Luke, as far as things are at the moment. You don't deal with everybody on this side.
No, that's exactly the case. In our old guys at NMP, we had a panel of 600 brokers, but perhaps more than that, and it was ever growing. When we've reformed as YBS, we've changed our strategy, and we're looking for a small, compact panel of brokers that we can deal with regularly, that we can build those relationships, that understand our products. We have made the onboarding a little bit easier than it was previously in terms of the paperwork involved, but we're still quite selective around the firms that we're able to onboard. So I'd invite anyone on this call that has a transaction they'd like placed to us, go through the specialist hub, and they'll be able to work with us to bring the deal to us. That's the best route for anyone on this call to be able to put deals in place and for us to get them moving for you. Okay,
as you can see on the screen, quite as with every speaker today, we do have a dedicated page, which I believe is being worked on at the moment. So forgive me if when you go on it looks blank. It is being worked on. It will be up this afternoon with all the information. It's quite a difficult task getting the lender documentation uploaded at times, so that it can then be downloaded and used properly. Again, we've got a dedicated 0800 number for YBS and also a dedicated email address. One more question just popped up from Caroline again. Thank you, Caroline. Thanks also. Do you do expat loans?
No, we don't. So all of our borrowers need to be UK based. So we'll look for them to have been residents for at least the last 2 years. And they'll either need to be UK nationals or people with an indefinite rights to remain, EU residency included in that.
Okay, I've run out of questions, Luke. There's no more questions coming up, so thank you very much as always. Great to have you. Great to have you with us. Great to see that the hair's coming on the way it is. It's absolutely marvellous. I'd book your haircut if I was you for early December. I've already booked mine in. So we will say goodbye and bring on our final speaker.
Thank you. Real pleasure.
Thank you. Cheers. Thank you.
Brilliant. Take care.
Okay, our fourth speaker is Christian Gugolz from MT Finance. I've just realised an MT Finance logo in the bottom there underneath his name, which we'll have to change. I'm not sure if Christian is with us as yet. I'll just check. Yes, he is. He's just coming on now, so I can now crack on with his introduction. So everyone, you should have received a 4-page document which we printed on A3 paper, folded in half for you. So you've got their residential product guide and all the other commercial, everything is within that you need. And everything Luke's covering, Christian's covering today. Christian, hi, how are you?
Hi, good, thanks. How are you?
Good. You seem like it's like a little lightning bolt going down your screen.
It's probably the light. Just bear with me for 2 seconds.
Yeah, no problem at all. No problem at all. So just a little bit of introduction to Christian. He joined MT Finance from the loan brokerage Amiga Loans, where he focused on the development of its commercial bridging and secured loans business. Christian started his career at a legal recruitment company before moving to a commercial outsourcing solutions firm where he held the position of national account executive. He covers London and the southeast of England. Christian is responsible for introducing new brokers to their panel in this region, as well as strengthening MT Finance's existing relationships. Must say, MT Finance probably was one of the strongest lenders throughout lockdown. They really were right at the forefront of lenders willing to go the extra mile on stuff. Absolute godsend to many brokers out there. When so many pulled out or just restricted their terms, they really were there throughout. So, and they've been around a long time. They were one of the first bridging lenders to come into the market all the way back. I think it was 2008, 2009, I believe, probably in Christian's presentation. So Christian's always very, what's the best word to use here? Laid back on the information he gives us. So his surprising fact that he gave us was that he was born in Switzerland. And he's also a big Supertramp fan. When I was just editing these slides last night, I said to my wife that he was a big Supertramp fan. She said, "Who are they?" So I then played some music to her and she realised who they were. I got this, and that's all he gave us. So I got this from his LinkedIn feed, because if they don't give us, the speakers don't give us enough information, I then hunt down information on them. And one of his brokers said, having Christian as your BDM is like ordering 10 chicken nuggets and getting 11. So there you go. But the other thing that he didn't actually say, and this should be his proud fact, and I did cover this last time, he was the brains behind the LinkedIn Golf Bucket Challenge. I wasn't invited to that, by the way, because I would still be playing it and still searching for my ball. That took place during lockdown, raising more than £8,000 for the NHS heroes. So a virtual round of applause, please, for Christian, because that was an absolutely superb effort. It really was, for the entire marketplace, and also the charities involved too. As I say, I decided not to participate. I haven't played golf in 14 years now because I was the world's worst golfer officially. So, Christian, on to you. It's now yours.
Thank you very much.
I will see you in about 20 minutes.
Good stuff. So, good afternoon, everyone. Or good morning, even. Still not just there yet. Thanks for having us on, Tony. It's good to be here again. I think these webinars actually are quite helpful, particularly with lockdown part 2 happening. I'm not sure how much of a lockdown it could be compared to last time, but here we are. So as Tony said, obviously I've just got a few bits to go over. I'm Christian Gugolz, business development manager at MT Finance. I've been here now 4 years actually. Tony mentioned we've been around since 2008, which is correct. So about 12 years now. So we're still here, still going, still able to help with your inquiries. Confirmation in the last couple of days that all of our surveys are going to stay open over the next 4 weeks or so, I believe, as well. So still good to go. So as Tony mentioned, MT Finance, for those who didn't know, stands for Mutual Trust Finance. We've been around since 2008. When I started, I was employee number 10. There's now around about 32 to 33, maybe even 34 of us now. We've won around about 20 awards over the years, a number of those for service, a number of those for best bridging lender. But it's great to be part of a business that is consistently recognised for the work that we do. We have 4 directors, 2 of which are the founders, one who's a solicitor by trade, and one who's a property investor. So neither of them are actually from a banking background, which is, I think, quite different to a number of other lenders, and I'll come on to that in a bit shortly. And now we've got 4 BDMs as well. So myself covering London and South East. We've got another one covering London as well, one covering South West and Wales, and one up in the north. So we do cover the whole of England and Wales when it comes to lending, not Northern Ireland and Scotland, or not Northern Ireland and Scotland, unfortunately. But we do have exposure across the whole of the UK. So apart from those two areas, but any questions, obviously, give us a shout. So just to kind of give you a few details on our basic parameters, I'm not going to go into too much detail. And hopefully Tony will be able to distribute the actual product guide to you at the end of this presentation. As you can see there, we do cover four areas: residential, semi-commercial, commercial, and heavy refurb. The residential side of things is the main area that we cover. Now, when I say residential, I do mean investment properties. So as it stands, we're unregulated only. So we're not looking at the regulated side of things. I've got a slide in my presentation about the thing called bridging trends that actually shows you the mixture of regulated and unregulated at the moment. It's incredible how much regulated business there is out there. I think that's mainly to do with the stamp duty, but I will come on to that shortly. So as you can see there on the residential side, we do cover first and second charges. The second charge side of things, we probably are one of the best, I believe, within the industry. It is about 30 to 35% of our business, mainly because I've just realised, Tony, this is the wrong presentation. I think I've added some other slides in that I sent across last time, so I'm going to have to kind of add that in very, very shortly. So first and second charges across the board. We are max 65% gross on the first and second charges. We have been able to try and get to 70% at the moment. So we are trying to be more flexible where we possibly can. Mainly because it's the kind of the industry, particularly since lockdown ended last time round, has become more and more competitive. So we're having to try and work around that and try and kind of push the parameters wherever we possibly can. I mentioned second charges there being about 30% of our business. We can also look at second charges on a main residence for a business purpose. So I mentioned we don't lend on a main residence on an owner occupied because that is classed as regulated, but we can do a second charge for a business. So as you can imagine, there's a lot of people at the moment, particularly small business owners, that probably need some extra funds to keep their business going, for some cash flow. Property investors that might need money to purchase some more investment properties, to put deposits down, etc. Some companies needing to pay HMRC tax bills, that sort of thing. So anything that's business related, we can do a second charge on a main residence. Now that is restricted to 65% gross, so we're not going to be able to go anything above that, unfortunately. Rates start from 0.69, sub 40%, and we can look to go up to 65, 70, and that will be at 0.85. We are what you call a non-status. I wouldn't say non-status is the right word anymore, but we are kind of an asset-focused lender. So we don't necessarily look at the client's income or affordability or anything like that. So it just makes the process slightly more straightforward. Most lenders will, what they'll do is they will look to add in the underwriting of the client after the valuation of the legals. We don't have that part in our process, and I'll come on to the process shortly, but it just makes that slightly easier, slightly less tape, not many questions to be asked. When I mentioned about the new inquiry form, it will kind of give you an idea of how easy we are to use. Development exits we can do on residential. If there are any structural works to be done, that will fall under the heavy refurb side of things, which I'll also come on to shortly. But generally speaking, the development exits, when there's kind of internal stuff to be done, and it's just kind of your last bits to be done, that would fall under a residential product. Another thing that's not on there as well, which is quite a big thing, two big things for us actually. You're looking at below market value purchases. So currently we're seeing a lot of those, in the sense that people are actually managing to get good deals, not just through probate, not just through other things as well, but there's also a bit more of that going on at auction as well, which I didn't think was actually happening too much beforehand. So development exits, we can look at that. Sorry, the below market value purchases, we can actually go up to 90% of the purchase price, not to exceed 65, 70% of the open market value. So generally speaking, the open market value is what we'll lend on. If we can, we'll lend on the purchase price up to 90%, so the lower of the two. On the semi-commercial side of things, sorry, one more thing I will need to mention on that as well, short leases. I know a lot of lenders struggle with short leases, particularly when you're looking to go into a term product. So we can look at properties with a short lease. I think the lowest we've actually gone before is 7 years. We would obviously require the client to use those funds or other funds to actually increase that lease on the drawdown of the loan. So it needs to be a simultaneous transaction. So with the drawdown happening and also adding in the lease at the same time. Semi-commercial, we look at first and second charges up to 65% gross. The rates on that side start from 0.85. With the semi-commercial side of things, we are looking at kind of your shops and your uppers mainly on your retail, on your high streets. So there are plenty of those going around at the moment. There's also a lot of people actually looking to purchase those and convert either the downstairs into flats or into further flats, or also convert the upstairs into maybe from 1 to 2 flats or 2 to 3, whatever it is. If there's no structural works, then that will fall under a semi-commercial product guide. If there are, then that will come onto the heavy refurb side of things. Commercial, say there again, first charge is only currently. If it's a very, very low loan to value and the first charge is quite small, we may look at a second charge. If there is another asset involved, another property involved in the transaction, it is probably more likely we are looking to do a second charge because there is extra comfort there. Rates again start from 0.85. The types of assets we lend on there are kind of your retail space, your office space. We don't unfortunately look at industrial stuff, so no light industrial, no warehouses, nothing like that, unless again very, very low loan to value or it's included within another property. So what I can say from looking at those types of things, we are very, very flexible when it comes to what we look at. Most lenders will have, so a lot of lenders will have a computer system that has their criteria, and you say computer says yes or no. From our perspective, it's all about having the conversation, understanding the deal as a whole, and actually looking at it and thinking, well, we're taking that common sense approach and thinking, well, does it make sense? Can we do it? So it's all about having that conversation. The heavy refurb product is slightly different to a few other lenders that you might already know. So we can't actually do purchase and works day one. We actually lend on the day one value, and that would be up to 65% day one. The cost of the works can't really exceed 70% of the current value. So if your property is worth 100,000, the cost of the works shouldn't really exceed 70,000. We have been able to go out of criteria on that. It just depends on the deal, whether it makes sense, what the GDV is, and whether or not the end target of the property is going to be kind of, you're going to get a good profit from that. The max loan to GDV, generally 60, sometimes 65%. And we are looking at rates from 0.8 as well. And we can get up to 100% of the cost. Again, we can obviously cross-charge across two properties in there as well.
Christian?
Yeah.
Christian?
Yeah.
Christian, can you hear me?
Yeah, I can hear you.
Yeah, there's a few connectivity problems we're having on yours. So what I'm going to do is your presentation, we've loaded up your own presentation, unfortunately, which is entirely my fault.
That's okay.
When you do things sort of like at 11:30 at night the day before.
No worries.
So I've actually just uploaded the correct one and we'll get it onto the right page. So again, my apologies, everyone. Entirely my fault. Hopefully we'll find it. Here we go.
There we go.
I'm not sure what you're up to. It might be about
It's fine. I'll leave it on this one for the time being. I can go on to the next one. There's a couple of bits that I've mentioned already, but I can just go over those again.
Yeah, fine. Apologies, everyone. I'm off again. Right.
Cheers, Tony. So as I was saying, up to 100% of the costs if we need to. It just obviously depends on what the value of the property is. What we can do is we can actually lend further tranches as well in arrears. So if the client has the money to start the works, and they can get the property to a position whereby they're adding value, we can then lend further funds. We can do up to further 4 tranches. So if somebody's adding square footage, for example, then that's going to add value to the property probably within the first 3 or 4 months. We can then add extra funds on top of that against the new value. So we do it on a revaluation basis. If they have money to start the works, but the first thing they're going to do is strip out the property, that's obviously not going to increase the value. So that necessarily wouldn't work on that side of things. So that's the heavy refurb product. It does work. It's better if the client owns the property outright. If they bought it cash, but we can look at those side of things. And when I talk about heavy refurb, I'm looking at structural works, extensions, conversions, loft conversions, those types of things. So anything on that side of thing we can look at. I've already mentioned a couple of things on what you'd use a bridge for. So I already mentioned kind of your below market value purchases and your lease extensions. There's a number of other things as well on there. So development exits, time restricted transactions for us is quite a big one, because obviously bridging's supposed to be quick. I'll come on to the bridging trend shortly, but the average, I think, turnaround time for a bridge in the last quarter was actually 52 days. You look at 52 days and think, well, that's not quick. We as a lender, I would never come to you and say we're the quickest on the market. You should use us for speed. We are quick. We can complete within 2 to 3 weeks. But a lot of that is dependent on the valuers and the solicitor. So from our perspective, we get things done very, very quickly. We also obviously have to rely on third parties when it comes to your solicitors and your valuers. So the time restricted transactions we can do very, very well. Obviously auction purchases are required to be done within 28 days. That is never normally an issue for us. Buy to let purchases, obviously that's quite standard. There's a lot of that going on at the moment. Capital raising, which I already mentioned, so you can use current investment properties or your main resi on a second charge basis to actually raise funds for anything that you require going forward, as long as there's a good exit in place. And also refinancing existing loans. So for those of you that do bridging, you would have noticed, I think over the last 6 to 7 or 8 months, there has been a lot of need for re-bridging, mainly because clients haven't been able to exit those, because they haven't been able to get the refinance, or because they haven't been able to sell. So from a re-bridging perspective, we are happy to do that. Every single deal is looked at on a case-by-case basis, mainly because we obviously want to ensure the reason why they couldn't redeem, and the reason why they couldn't obviously get out of that and get onto either a refinance or sell that property. So we will look at that in more detail. We are generally restricted to 60% currently on a re-bridge, but we can obviously look outside of that if it's a good deal and it makes sense. Okay, so just wanting to give you a bit of an idea on kind of how the market is looking at the moment. So as I mentioned earlier, the average 52-day completion. So this data here, we work with a number of different brokerages that will compile their data at the end of each quarter and actually send this through to us. So this comes from about 10 to 15 different brokers. The information is quite interesting to see. So you can see there that the regulated versus the unregulated, which I mentioned at the start, regulated last quarter was 53% of the deals. Now, I think that was the first time regulated actually outshone the unreg market within 5 years. And I think it's the highest it's been since we've actually started the bridging trends, I think 5 or 6 years ago. So you can see where the market is moving. Average completion time, again, as I said, 52 days. It's not very quick, but the average completion time for us generally is between 15 to 20 working days. So as I said, kind of, or 10 to 15 working days. So 2 to 3 weeks. You'll see all these different rates as well on the market. I think the lowest at the moment is 0.49 on the unregulated side. However, what you'll notice there is the average monthly interest rate is actually 0.78. So when you look at our rates and think, well, actually you're more expensive than the lenders, it's not necessarily always about the rate. It's sometimes just about getting the deal done. A lot of that is obviously down to what the client would like, whether they want the rate, whether they want the speed, whether they want the service. From our perspective, it's the service and the speed that we work on, the transparency, etc., the flexibility, and actually being able to get a deal done. Total gross lending there, you can see 115 million. That was an increase of 36 from Q2. So you can see obviously through lockdown, it actually dropped ever so slightly. And then it did increase again as we slowly started to come out of that. And the bridge and loan purposes there, you can see the main reason at the moment is still for an investment purchase. Before all of this, the main reason I think was for a refurb, but you can see all the different reasons. You've got chain break, business purposes. You've got other at 1%, the regulated finance 17% there. So there is a big mixture of what is going on there. I think I've realised I've actually missed a slide out after all that. Just bear with me for 2 seconds. Sorry, guys. So yeah, what makes us different? I should have done this beforehand, but I just wanted to make sure that this obviously is one of the most important things from our perspective. So what makes us different is we are an asset-based lender. So when we're looking at deals, we are looking at the asset and not necessarily the client. We obviously are interested in the client, but when it comes to things like adverse credit, CCJs, that type of thing, we're actually okay with. You'll see there the types of borrowers we lend against, we lend to. So you've got personal, LLPs, expats, foreign nationals. We'll also look at foreign nationals without any footprint in the UK as well. And one thing I have missed off there on purpose is generally the limited companies. And the reason why is because I wanted to outline that we don't actually take PGs from a limited company perspective or any debentures. Most lenders will ask for that type of thing. The only time we'll ask for it is when it's kind of maybe a larger deal and we just need slightly more comfort, but 9 times out of 10, we won't ask for any PGs. As I'd already mentioned, we take a sensible, pragmatic approach to every deal that we look at. Every deal that you get across your desk is different. We have criteria, but that criteria is there mainly so you guys know what we do, but there's no reason why we can't look to go outside of that if the deal makes sense. So it's just about being flexible. Mentioned earlier about an inquiry form. So we have a 1-page new inquiry form. I say 1 page, it's an A4 side with 2 sides, but generally speaking, the only things really asked for is that and a credit report to actually be able to get things moving. And on that inquiry form, it's basically just the property address, the property value, how much they need, what the purpose of the loan is, and what the exit is. So it's very, very minimal information. Fit for purpose, transparent terms. Transparency for us is one of the biggest things. There's no point in giving you terms and then 2 weeks down the line actually saying, well, this has changed, this is what we've added in, etc. So day one, when you see the terms, everything will be outlined with regards to the interest, what the legal costs are. All of that will be outlined day one. We'll be able to see it there. We are retained interest as opposed to rolled up, so you can actually see the overall cost at the end. We have no exit fees or ERCs with a 1-month minimum term. So if you take a 6-month term and you redeem after 2 months, you're only paying 2 months interest. We actually had one loan recently that was I think it was a 6-month term or a 12-month term, and it actually redeemed within 3 weeks of the loan happening. So they actually only paid 1 month interest on that. Excuse me, sorry. And the speed and the service and the transparency, which I already mentioned, we have people that will make it happen. We have the underwriters with the legal experience as well. So I mentioned earlier our two directors, the 2 guys that own the company, one of whom is actually a lawyer by trade. That means that when it comes to making commercial decisions on the legal side of things, then we can actually move things along quickly and make a quick decision. We don't have to heavily rely on our solicitors to make those decisions when it comes to the legal side of things, which generally does speed up the process quite a large amount. Okay. Sorry about this. So the process, which I've already mentioned a couple of times, so it's a very, very straightforward process from our perspective. So you've literally got 5 stages: applying, the offer, the valuation, the solicitors, and the funds being released. Now, the valuation and the solicitors, they can actually run side by side depending on what the client wants and how happy they are with what the valuation is going to come in at. Day one, if you send us an email with some very, very brief details, we can actually get you some indicative terms out. Now, those indicative terms generally come out within the hour. I think the quickest we've ever done it is 6 or 7 minutes. So you can see how quickly we want to move on these things. When it comes to those indicative terms, if the client is happy with those numbers, all we require from you is a copy of the new inquiry form, which I mentioned already is only a 1-page form. There's no application form for the client to fill out. With that new inquiry form, we just need a copy of the credit report. So all the ID, etc., that's all done through the solicitors. That credit report can either be Experian or Equifax. And on the back of that, we can generally get you a offer in principle out within 2 working hours. Now, that offer in principle is definitely worth noting. This is effectively fully underwritten and fully credit backed. So we don't have a credit team at the back end. And we have no further real underwriting to do back end either. So that is just subject to valuation and legal. So providing that valuation comes back at what the client indicated at the value, then we're good to go, obviously subject to legals as well. So if that valuation does come in down valued, or it comes in valued more, God forbid, I don't think that ever happens, but if it does, then we can obviously look to change that offer in line with what the valuations come back at. Now, I mentioned obviously the valuation, the solicitors and the legals can happen all in one go. They can. So once that offer in principle is signed and sent back and the client's happy to move forward, we will instruct the valuation on the back of the payment from the client to us. If the client wants to move things quickly, if they pay the legal undertaking to the solicitors, then obviously the solicitor can start doing their work alongside when the valuation is happening. So if the valuation is happening in a couple of days' time, we can obviously get the solicitors to start working as long as that undertaking has been paid. Now, once that all happens, the valuation comes back okay, the solicitors, they get all the work done, then that's when the funds release. So we've got no underwriting of the client there. At that stage, a lot of lenders would actually underwrite the client, and that will change the deal sometimes because of what the client's income is, what their affordability is. That will change that, and then it will go to the credit team, and then it can potentially change everything. So from our perspective, that doesn't generally happen. There should be no changes unless anything comes out in the legals or the valuation that we weren't aware of day one. Excuse me. So just got a couple of case studies to show you here, just to give you an idea of what we can look at. So this one was a semi-commercial auction purchase. This actually one I think happened during lockdown, so we had to improvise slightly. So the client required 400,000, and they only had 3 weeks to complete the transaction. And obviously they were running out of time, where they risked losing their deposit. So on the receipt of the inquiry, we issued the offer in principle. We're able to instruct the valuation and the solicitors on the same day. And because we were working from home at the time, the client actually arranged to meet the solicitors to sign the documents. That allowed us to complete the transaction within 10 days, providing the loan at 65% over a 17-month term. So what that allowed the client to do was significantly increase the value of the property to actually to do some works, and then able to sell the investment at a higher value. So very, very quick loan there, giving the client what they needed quickly. Second charge to fund works. This one was actually a second charge on the actual investment property to do the works on the property in question. Now, with this, because it's an investment property, this is an instance where we can actually look to lend on the main residence. So if the client is looking to do works on their investment property, we can either lend on the property in question, or we can actually lend on the main resi to raise the funds, because the funds are going towards an investment property, which is effectively a business purpose. Now, as soon as we received the case, the underwriters were straight on the phone to the client's solicitor to find the solution with obviously the social distancing. We were able to accept a retype of the valuation from the previous lender with an audit from one of our panel surveyors. So in just 3 days, because of all the work that had already been done, it was actually one that came from another lender that pulled out. We were actually able to provide in 3 days a £490,000 second charge loan over 65% over a 24-month term. Again, no exit fees, no ERCs, and no personal guarantees were required. That again gave them the funds to increase the value of their property and then sell on at a high value. And just the last one, which generally covers the heavy refurb side of things. So this particular client had purchased a barn cash. So in this instance, we were actually be able to provide the funds day one for the works, and that was through an SPV requiring 236,000 to develop the asset into 3 residential dwellings. The GDV of that was around 1.8 million. So in 10 days, we actually provided an initial loan of 160,000. And then we were able to fund the works with further tranches down the line in stages. So that allowed the project to be more cost effective. So day one, you can see we're at 40%. Once the client actually did some works, we could actually increase the lending against the new value. So having that lower loan to value day one meant that the rate was slightly cheaper, and keeping the loan to value at that level throughout the project meant that it was a more cost effective way to do the project for the client. And obviously once he completed, he was able to sell the asset at a high value to exit our loan. And that's it from me. Thank you guys for listening. Hopefully you've got a bit of insight of what we do. Any questions, obviously, just let me know.
Okay, again, everyone, apologies. That was entirely my fault. I put up the wrong slide when I was doing it last night. I'm going to blame my wife, because I was talking to her about Supertramp at the time, which she'd never heard of. And I had to play her various Supertramp tracks so she'd know who they were. And that was just as I was uploading the thing. So I'm going to blame her, but please don't tell her that I'm blaming her, everybody, if you meet her. said that's an excellent presentation. I agree. And Paul Rhodes said crime of the century. That's not relating to my uploading technique. It's actually more to do with, it's actually a Supertramp album from what I remember. So there's several people typing. Yes, Eno, of course you can ask a question. Whilst Eno's typing his question, I've got a couple here. So Christian, what trends do you predict for the bridging market?
That's a very, very good question. I think it's one that's on everyone's lips at the moment. I think the market at the moment, I think it's on the up. I think with the first lockdown over, clients were actually starting to move forward. There's plenty of properties out there to be sold. I think there's going to be a lot of conversions happening. People seem to be buying up commercial and semi-commercial properties, I think for obvious reasons, mainly because people don't want them anymore. So they're looking to use bridging to actually purchase those, do the works, and then either put on to buy to let or sell on at a higher value. So I think the regulated market is going to continue on an up and upwards spiral for the next kind of 3 or 4 months, particularly until the stamp duty changes end. I think the unregulated market is going to lean towards your commercial and semi-commercial purchases, but I also think people are still taking advantage at the moment of using bridging to buy to-let properties. And I think there's a lot more people actually taking advantage of your lower value properties as well, and actually buying below market value and using people like us to get you 90% of your purchase price. So I think it's in a good position. Conversions are definitely up, inquiries are definitely up. So we will hopefully keep our fingers crossed that it continues to happen.
Okay, we've got Caroline has asked, I'll come on to you in a moment because I'm not quite sure what you mean by secondary bridging, but yeah. Caroline has asked, what would you lend to a church?
Good question. We don't generally lend on places of worship or things like nurseries, schools, those types of things, mainly for kind of your reputational risk. Now, if that church had planning for residential housing, then potentially yes. It does largely depend on what that planning is for, what the value is, what they need, etc. If it's just a church and it's got the church usage, then unfortunately no, we wouldn't.
Okay. Eno's asked, what is the maximum size of transactions? What's the largest loan
if you say again, sorry.
What's the largest loan you'll do, basically?
Good question. So we lend anywhere from 25. I know this isn't something I covered actually. I should have done. We lend anything from 25,001 all the way up to 10 million. The 10 million side of things, so that the larger end, we wouldn't necessarily do a large loan on a single asset. So to date, I believe our biggest loan is around 7.5 million, and that was across 6 properties. So if you've got a prime real estate within central London, we're probably not going to do 65% on something around 10 million. That will generally have to go across kind of 3 or 4 properties, but we will look up to a loan size of 10 million.
Okay, and Eno has asked, secondary bridging is just clarified, is refinancing another bridge portfolio?
Again, as I mentioned before, we will look at that. It does largely depend on the reason they need to rebridge. So if they've had a bridge in the first instance and they haven't been able to exit it, we need to understand why they couldn't exit that and what they then need the further bridge for. If it was for a case of they couldn't sell the property because of the market currently, then we would probably look at that, maybe up to a maximum of 60%. If it's a case of their initial exit was sale and they haven't even put the property in the market, then we're probably not going to look at that. But it does largely depend on what the original bridge and exit was and why they couldn't exit.
Okay. Okay, haven't got any more. Just says he's got a large portfolio in his hand. So
we'll have a look. We can have a look.
Okay, just everyone, the slides that obviously was missing because I uploaded the wrong presentation is that if you do need any documentation, exactly the same as with all the other lenders, just go onto the Specialist Hub website, click on MT Finance, and it's got all the documentation that you'd need for as to how to work. We have got package of status with them, so come to us. You're doing the same as if you went direct, but obviously you also gain our expertise in presenting cases. And also the fact that we can do credit searches right at the start, so that show MT Finance exactly what the client's situation is, rather than relying on the client to provide something. We can actually get things moving straight away. So, Christian, thank you very much indeed. Once again, my apologies for uploading, for confusing you so much by uploading the wrong slide, but just glad that technology allowed us to actually put the right one up.